Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Olokobi Pelumi by name, the accounting tutor who will be treating accounting ratio in this class, and we will be looking at the meaning of accounting ratio, types of accounting ratio, and also we are going to take illustrative questions on accounting ratio. First thing, what is meaning of accounting ratio? Generally, ratio shows the relationship between two or more figures. So accounting ratio shows the relationship between two or more accounting figure or accounting terms. So generally, we have different types of accounting ratio. We have number one, we have the markup. Number two, we have the margin. Number three, we have the rate of turnover, rate of stock turnover, and number four, we have the net profit expressed as a percentage of sales. Thereafter, we have the gross profit expressed as a percentage of sales. While the next, we have the manager commissions. These are the common ratios we have in accounting. So the first one we have the markup, followed by the margin, then we have the rate of stock turnover, thereafter we have the net profit expressed as a percentage of sales, then next one we have the gross profit expressed as a percentage of sales, then the last one we have the manager's commission. So firstly, we'll be looking at the markup. The markup is the relationship between the gross profit and cost of goods sold. So the markup is an accounting ratio which shows the relationship between the gross profit, between the profit of the business and the cost of goods sold. So the markup is the profit expressed as a percentage of cost of goods sold. That is the markup. That is, markup is going to will be equals to profits over cost of sales or cost of goods sold times 100 over 1. That is the markup. So it is usually expressed as a percentage of cost of goods sold or cost of sales. Now the next we have the margin. The margin shows the relationship between the profit and sales. So it is the profit expressed as a percentage of sales. So the margin will be the relationship between the profit over sales times 100 over 1. So one interesting part about this two type of ratio is that they are having some aspect of the relationship between them. So there we have the relationship between markup and margin. So we can easily look at the relationship between markup and margin. So the relationship between the markup and the margin. So since the markup is the profit expressed as a percentage of cost of goods sold, or the relationship between profit and cost of goods sold, so we can actually derive our markup from the margin, or we can also derive our margin from the markup. So when we have this, for instance, when we have markup equals to 1 over 5, and again we have we can actually derive our margin from the markup. We can derive the margin from the markup. So generally the markup is profit over cost of sales, and we know that generally our profit is equals to cost of sales is equals to the sales minus cost of sales. So the profit is equal to sales minus cost of sales, and sales is equals to cost of sales plus profit. And again, cost of sales itself can be calculated as thus. That is sales minus profit. So when we have this markup which is the difference between the profit and cost of sales can be determined, can be changed to margin, and it can be changed as thus. We have margin, which is going to be equals to, when we have the markup, which is profit over cost of sales, and we know that our sales, although the margin shows the profit over sales, but what we have there is cost of sales. So we can convert the cost of sales to what? To sales. And we know generally that sales is equal to cost of sales plus profit. So it means when we add the profit, which is our numerator in this ratio, to the cost of sales, that will change to sales. So we can add plus profit. So we are going to have profit over what? Cost of sales plus profit equals what? Equals sales over sales. So the markup over here has been changed to what? To margin. So for us to change the markup to margin, we have to add the figure we have at the numerator to the figure we have at the denominator. So we can also convert the margin to markup. So how can we convert margin to markup? Let's assume we have this, we have markup, and generally our margin is profit over sales, and we know that that the markup must be what? Profit over cost of sales. So how can we convert this sales to cost of sales? So we know generally that cost of sales is what? Sales minus profit. So it means we have our profit here. We can easily subtract the profit, which is our numerator, from the sales. So minus profit, and that is going to give us the profit over the sales minus profit. That give us what? That will give us the what? The cost of sales. So generally, to convert the markup to margin, we will have to add the numerator to the denominator to convert the markup to margin. And why also to convert margin to markup, we will have to subtract the profit from the sales. So when we are given markup as 1/5, our margin will be, so we have the markup which is profit, 1 is profit and 5 is what? Cost of sales. So we will have to convert this cost of sales to what? To sales. So these are our profits. So we have 1/5. So the profit will be added to the cost of sales to become sales. That will be 1. That will give us 1/6. So another illustration, we can be given 1/3. You can be given 1/3, that is margin. 1/3 to be converted to what? To markup. So we have our markup will be, so we have 1/3. We have 1/3. The 1 there actually stands for what? Profit, and the 3 stands for sales, because it is margin which serves as the relation between the profit and the sales. So 1 is the profit and what? 3 is the sales. So we want to convert this to markup, and markup shows the relation between the profit and cost of sales. So this sales has to be converted to what? To cost of sales. And what happened? For us to convert the sales to cost of sales, we will have to subtract the profit from the sales. So we have 1/3. So the 1 we serve as the profit will be subtracted from the 3 we serve as the sales. That becomes our cost of sales. That means our margin, our markup will be 1/2. So let's take an illustration again. Let's say we have markup 5/15 rather. So our margin will be what? Profit over cost of sales. We add the profit to cost of sales to become sales. That will be 5 over 15 plus 5. That then give us 5 over 20. Also, we can have margin, which is 6 over 20. We should convert this to markup. Markup. So, the markup, the margin which shows the profit over sales, can be converted to what? Markup, which shows the what? Profit over what? Cost of sales or cost of goods sold. So we have 6 which serve as the profit, then 20. The sales will now be converted to what? Cost of sales. By subtracting profit from it, minus 6. That will then give us 6 over what? 1 over 14. That will become our markup. So that is all about the relationship between the markup and the margin. So thereafter we can move to, okay, let's look at how we can convert markup to margin and margin to markup in percentage. Let's assume we have markup as 20%. So that means 20% will be 20 over 100. Then they give us 20 year 1, 20 year 5. That gives us 1 over 5. So our margin will then be, I think we've done that earlier, 1 over 5 the margin. That gives us 1 over 5 plus, sorry, our margin will then be plus 1. That gives us 1 over 6. Or in percentage that becomes times 100. That becomes 3. Then it becomes 50. That becomes 3 over 50 percentage. So that is all about that. That is all about the relationship between the markup and the margin. So we can thereafter move to the next ratio. We can thereafter move to the next ratio, which is this rate of stock turnover. Of stock turnover. So the rate of stock turnover is the ratio between the cost of goods sold over average stock in the period. So the rate of stock turnover shows the average number of time in which stock is being turned over in the period. That is how stock are being sold within the period. So that is what we call the rate of stock turnover. So how can we derive the rate of stock turnover? That will become, we can derive at that. That will be cost of goods sold within the period over the average stock in the period. So the number 4, we have net profit. That is the next ratio expressed as a percentage of sales. So the net profit in this ratio, the net profit is expressed as a percentage of what? Sales. So that will be net profit over sales. Now we have the next ratio, which is the gross profit expressed as a percentage of sales. So that will be gross profit over sales times 100 over 1. So the next ratio we have manager's commission. We can use stop here. So we have the manager's commission, that is the 6th ratio. We have the manager's commission, and that gives us percentage commission over 100 plus percentage commission times profit before commission. So to calculate the manager's commission, just a form of ratio, we are going to have the percentage commission plus 100 plus percentage commission times profit before commission. So we have an illustration The following was extracted from the book of Ojo in 1991. Stock at 1st January 1991, we have 6,500. Stock at 31st December 1991, which is the closing stock, we have 5,500. The next one, we have creditors for January 1991, we have 4,000. Creditors 31st January 1991, we have 4,000. Okay, December 31st 1991, 5,000. Cash paid for goods during the year, we have 20,000 naira. We have markup of 25%. Selling expenses 2,750, and we are asked to calculate the margin, purchases, stock turnover, gross profit, sales, and also we are asked to calculate the percentage of gross profit on sales. And next, we are also asked to calculate the percentage of net profit on sales. The first thing, we have the markup. Okay, we are given the we are asked to calculate the margin, and generally the markup is 25%, which is 25 over 100. Then we have 25 here 1, 5 here we have 4. So generally we can convert that the markup to margin, just like the way we did in the difference between margin and markup. So this profit and this is what cost of sales. So when we add our profit to the cost of sales, that becomes what sales, which is the margin. So we have the profit over 4 plus, which is the cost of sales, plus profit itself, that gives us sales, that is the profit over sales, which is 5. So that is our what? Margin, or 1 over 5 times 100, 5 here 1, 5 here 20, 20%. So we have done that. Now the next thing, which is B, we are asked to calculate the purchases. Okay, we are given the opening balance of debtors, we are giving closing balance of debtors, and we are giving cash paid for the goods during the year. So we can calculate the purchases through the control account we did in the previous class. So one of the advantages of the control account, I said in the previous class, is that it's used in calculating missing figure. So we can calculate the value of the purchases due to the total creditor control accounts. So we can have total creditor control accounts. We have credit and we have debit. So we have the credit side, balance brought down 1991, which is 5,000, which is 4,000. So, and again we have cash paid during the period. So cash paid will be debited to the creditor account. So we have how much was being paid, 20,000 was being paid. And again, our purchase will be here, purchase during the period, which we are asked to find. Credit purchase will come to the credit side of the total creditor control account. So we are asked to find the credit purchase, and again we are giving cash paid during the period, that goes to the debit side of the total debtor control account. Now, we are giving the balance of the creditor at 31st December 1991, which is the balance carried down. So we can close this, then we can close this. It means the balance at the end of the period, which is the balance brought down here, is actually what? It's actually 5,000 naira. So for you to have 5,000 naira in this place, that means we must have for you to have balance brought down of 5,000, that means we must have balance carried down in this place, which is 5,000 naira. So balancing the account, we have 25,000 naira, and we have what? Okay, we are going to have 25,000 naira also in this place. So what will be in this place? Subtract 25,000 from 4,000. 4,000 from 25,000, that will give us 21,000, which is served as the purchase during the period. So the purchase is equals to 21,000. So we have purchase. So the purchase is equals to 21,000 naira. So we are asked to find the stock turnover. Say stock turnover is equal to the cost of goods sold over average stock. So we have to prepare the trading account to be able to calculate the cost of goods sold. So we just have to prepare the trading account to be able to calculate the cost of goods sold. within a period. So we can prepare the trading account to calculate our cost of goods sold, profits and loss account. So we have the opening stock within the period. So which is opening stock at 1st January 1991, 6,500, plus purchase within the period, so which is 21,000, which is 27,500. So we have closing stock within the period. We don't have carriage, you know why you return that to us, so we have to let closing stock since there's no such items in there. So this closing stock within the period is 5,500. And then give us 22,500. So these are our cost of goods sold. So we don't have our sales, but we are giving the what? The markup. The markup, which is the what? The profit expressed as a percentage of cost of goods sold. So we have the markup as 25%. So it means we can determine our profit through the markup. So it means 25% of the cost of goods sold will give us the profit. So profit is actually equals to 25% of the cost of goods sold, because the markup is the what? Is the profit expressed as a percentage of cost of goods sold. So we have 25%, that is 25 over 100, times cost of goods sold, which is 22,500. So 0 cancels 0, 0 cancels 0. So we have 225 times 25. We have 225 times 25. So we have 25 times 225. That gives us 5,625. 5,625. So our profit is 5,625. So we have so the addition of the cost of goods sold plus profit give us our sales. So we can calculate our sales. So we have plus 22,500. That gives us 28,125. 28,125. So we have 28,125. So we calculated our sales, we calculated our cost of goods sold. The next thing is to calculate our, we can call this as gross profit, or the same as profit. The next thing is to calculate our what? Net profit. So we have the gross profit, which is 5,625. 5,625. Now the next thing is to calculate our net profit. So we have the selling expenses. So we less the selling expenses from it. Selling expenses. So we deduct that, will give us, then they give us net. We have the selling expenses, which is 2,750. It's 2,750. So we can calculate our net profit. That is different between that and the net and the gross profit. So gross profit is 5,625 minus 2,750, and that gives us 2,875. So we can add that give us 5,625. 5,625. So we are done with the trading profit and loss account. So we can then move on to calculate our stock turnover. So we can calculate our stock turnover. So we've answered the majority of the question in there through the trading accounts. So in calculating the stock of turnover, we must be able to determine the cost of goods sold, which we are able to determine trading profit and loss account, while also we must be able to determine the average stock. So we have cost of goods sold, to be 22,500, whereas we also have the average stock, which is the opening stock plus the closing stock, 5,500 over 2, and that give us 6,500 plus 5,500, and then give us 12,000 over 2, that give us 6,000. So we can now calculate our average stock turnover rather. So stock turnover is equal to the cost of goods sold, 22,500 over average stock. That they give us 22,500 divided by 6,000. That give us 3.7 times. So that is the number of times stock is being turned over in the period. Now the next thing, we have to calculate the gross profit, which we've done in this place. So the gross profit is the what? Is the profit expressed as a percentage of cost of goods. So that is the markup. We calculated the gross profit from the markup. So our gross profit is equal to, is equal to this, which is D. We've done that already. Gross profit is equal to, that is the markup of the cost of goods sold, which give us the gross profit. So E, we have to calculate the sales. And the sales is what we have here. Sales is what we have here. That is sales is equal to 28,125. Now, and F, we have to calculate percentage of gross profit on sales. So we have F, percentage of gross profit on sales. So percentage of gross profits on sales is the gross profit over sales times 100 over 1. So we can continue that here. What is our gross profit? 5,625. What is our sales? 28,125 times 100 over 1. So interestingly, the percentage of gross profit on sales is our margin. That should give us 20% when we are done with this. So we have 5,625 divided by 28,125. That gives us 1 over 5 times 100. 5 here 1, 5 here 20. So that is the interesting thing about this topic. So is our margin. So the next thing we have is the percentage of net profit on sales. So G, percentage of net profits on sales is equal to the net profit over sales times 100 over 1. So we have the net profit to be 2,875 over the sales is 28,125 times 100 over 1. So we have 2,875 divided by 28,125. That gives us 23 over 225 times 100 over 1. So we have times 100. Then we have 10.22%. So that is all about the accounting ratio. So in this lesson we talk about the accounting ratio, the meaning of accounting ratio, and the different type of accounting ratio. That is the margin, the markup. That is the margin, the markup, and also we talk about this rate of stock turnover, which is the cost of goods sold over the average stock within the period. That is the number of times the stock is turned over within the period. Also, we talk about the gross profit expressed as a percentage of sales, and also we also talk about the net profit expressed as a percentage of sales. So we take an illustrative questions whereby we are able to convert the markup to margin and also convert margin to markup. We also have an illustrative questions whereby we are able to prepare the trading profit and loss account, and we are able to calculate our purchases from the total creditor control account. So if you are having any confusion as regards to the topic, do not hesitate to replace the video, and also some exercises will be displayed on your screen. Do not hesitate to attempt such a question. Thank you. So we can have